Welcome to the Unlimited Capitalist Show on the Best Ever CRA Network. Today's episode, we're going to jump into why we start with the fund of fund models, and we think most people should too. Now, this is where we talk about why we chose it for our first big deal ever. We'll talk about why we did it. We'll talk about a cheat code and how we put it together, and we'll also talk about compliance considerations as well. All right, let's jump into the show.
So here's why we started with a fund of funds, and you should too. Most people think that you would need a 10-year track record to raise serious capital, but we found a cheat code. That said, our first big deal was a fund of funds, but it wasn't our first deal. Both Chris and I were successful landlords. Both Chris and I were big believers in real estate, and we wanted to scale our real estate careers. We both knew that being a syndicator, raising capital, running big deals was where we wanted to go, but the problem was we knew that scale up was a big jump. So here's a cheat code we found and how we got into this business and ultimately raised $45 million in our first year of capital raising.
Yeah, now I want to rewind the clock because for this specific deal, it was a 34-unit multifamily value-add deal. Pretty typical deals a lot of our best ever listeners have invested in or done themselves. And we did this deal in Denver. Now, years before we put together this first deal, as Rich said, I already had a great portfolio of rental properties, and I had brokered a few $100 million worth of investment transactions. So I knew the game, and I knew I wanted to focus on bigger projects for scale. And throughout my last couple years before I did this, I was like, oh, how can I get into bigger deals? How can I get into bigger deals? How can I get into bigger deals? And I kept running into a roadblock. It's because I did not have the expertise, the operational expertise to go out there and take down a 34 unit on my own. That's very hard to do as a solo investor. And being around the block a few times as an investor, as a broker, I've seen lots of people have success. I've also seen lots of people crash and burn. And so as I was doing a bigger deal, especially bringing in OPM, other people's money, I wanted to reduce the risk as greatly as possible. And this is where our cheat code comes into play. Richard, I know you've heard this phrase, the who, not the how, right?
Yeah.
It's such a simple phrase, but man, it's like the tip of the iceberg when you start digging down into it. Because when you look at any deal, there's really two main parts of the deal. There's the deal acquisition, the deal operations, and there's the capital and the investor relations. You need both to make this deal happen. Some people are great at both. Usually people are better at one than the other. Now, I was smart enough, and I'll say humble enough to understand that running the operations and property management was not my strength, nor was it my desire. But I love real estate. I know deals. I have a great network. I love the value add component of there. And that's where we want to get into this bigger deal. So we were sitting there saying, all right, we know what it takes, and being humble enough, saying, hey, I am not in a position where I am to go take down this deal myself, where I can go out there and confidently look an investor in the eye and say, hey, Mr. or Mrs. Investor, I have faith in this deal. I have faith in myself. Come invest in me. Why? Because my track record was running single family, 1 to 4 unit residential properties with my own capital. Getting into commercial properties, Rich, we know this, that's a totally different ballgame.
Yeah, when you jump up to commercial, the complexity increases exponentially. I mean, everything from your loan structuring, you can't get a fixed year 30-year loan. That's a lot more risk. You need full-time property management. You need scaled and experienced rehab crews to improve the building. This is just like a giant skill set that at that point in time, neither Chris and I possessed. Now, that said, we knew people in the business, and Chris in particular was already an investor with an absolute all-star investor here in Colorado. And so we said, I would love to be able to bring one of my deals to him. And also, we'll get to learn the inside of this deal. We'll get to follow this process from beginning to end. We'll get to see how the capital was raised, how the deal was structured, and then be there on site, helping, learning how to take this deal down.
Yeah. But most importantly, we got access to a great deal, and we also greatly reduced the operational and deal risk for our LPs, which we take with a high confidence. We need to make sure that we are being good fiduciaries on here. So let's talk about the deal here, right? So this deal is in Denver, so not the most expensive market, but definitely not the cheapest market. It was a 34-unit apartment building, classic value add. Plus, we could add 1 or 2 bedrooms or 1 or 2 units by converting some storage rooms in the garden level area on there. So great value add on there. Needed about $2 million total in equity on there. Now, our partner on there, he was the operator. He was bringing about $1 million of his capital, and then we brought over just $1 million from ourselves and our capital group as well. And the reason we liked this was because proven operator, but also I could go out there and look my investors in the eye and have 100% confidence saying, look at this deal. Here are the numbers. Look at the operator. Look at this. And also, I'd invested in numerous deals with this operator before as an LP, just as a check writer. So I also had that confidence, the track record. I'd also gotten some distributions and dispositions as well from our investments. So I had a high confidence. So when I go out there and talk to an investor with a standpoint, then, think about my mentality back then of if I'm going out there saying, hey, Mr. Investor, come invest in this deal. It's a great deal, but this is my first time taking down a big deal. I'm going to have imposter syndrome, which we all have out there, right? And the investor, when I look at deals, I don't want to invest in someone's first rodeo, right? Nothing against the operator. We all have to go out there and do the first thing, but I prefer to invest people who've been around the block a few times. And so I wanted to focus on that as well. What were we going to say, Richard?
Yeah, there's another thing, which is, we have to go and present this deal to our investors. And the fact that you knew him so well and we knew how good his operations was and we'd been in his deals meant that we were able to very confidently and deeply explain the deal. Because if you're trying to have that investor conversation and they're like, oh, so tell me about this guy's track record or what's the business plan here or what's he's done. And you're like, well, I think this guy is done quite a few deals, as opposed to being like, oh, I'm in 3 of his deals. I'm in his last fund. I'm getting paid well from this fund. Everything is going great. And I cannot be happier to be in this deal and be able to bring it to you.
All right. So, step 1, we talked about the cheat code, finding the right who. Now, let's talk about the business plan and the economics on there as well, because it's very important to create that win-win-win scenario. We want to have a great win for our investors. We want to have a great win for the operator. And as a fund of funds, we want to have a great win for ourselves because we need to get paid as well. So when we go out there and look at the structure, Richard, can you give us a very high level understanding about how that works and how it's set up?
Yeah. So the way we've been explaining this, you might assume that we were co-GP on this deal. That is not the case. So what we had was called commonly a special purpose vehicle. So what a special purpose vehicle is an investment entity, typically an LLC, that is set up specifically for the purpose of making an investment. So that means ultimately our fund did not hold title to the property. So the operator we were working with, he had his main syndication for this property. And then our syndication or SPV was an entity that was an LP in that position. And here's the reason we did that. It was primarily because our role here was explicitly to bring capital to the deal. However, there's a thing called being a broker-dealer, which we are not. And so what a broker-dealer is that is a requirement by the government and the SEC and FINRA that if you are being compensated for raising capital, you must be, 1, licensed and pass a bunch of exams. Number 2, registered as a broker-dealer. And with that comes a lot of cost and compliance that we weren't ready for and did not want to undertake. And then if that was the case, how were we going to get paid? Now, it is technically possible, but that we think that the co-GP model, it's our opinion, that the co-GP model for capital raisers is really suboptimal. I think it creates a lot of risk for both parties and that it's just a much cleaner setup, namely that you are able to be compensated for all of the capital you bring in with an SPV.
I think you're being too polite here and too subtle, Richard, on the risk involved here, because you're talking about potentially, licensing issues and all that. But what we've seen numerous times in different operators out there, hey, let's say an operator's out there and they need $10 million from equity. Well, this capital partner says, hey, I can bring $3 million of it. So you say, hey, great, you bring $3 million, you get a 30% slice of this capital share, and then you have those documents outlined. Hey, I own this piece of the GP, you own this piece of the GP, Richard, and we know what it is. What happens when the capital partner brings in $300,000 instead of $3 million? And I'm actually referencing a real scenario on there. Well, if that happens, you're kind of up a creek without a paddle because you can't go back and modify the docs. It's very hard to.
Because it would be quite obvious you were changing the docs based on a transaction basis. That, you weren't able to bring as much capital, so we're not going to pay you as much. I mean, the general interpretation of that is that you are breaking the law at that point.
Yes. And I don't like to play in that area. I like to stay compliant. I'm going to go out there and do things well. And so that's a big reason why the fund-of-fund models is very attractive to operators out there, because many operators have been burned before by people promising one thing and they're delivering something much lower than that. So operators like that a lot more because it greatly reduces their risk, also greatly reduces their complexity. And then also for the capital partner, it makes it a lot cleaner for you. As Richard talked about, a lot more compliant as well. So this is a very nuanced topic here, but it is so, so important.
And consult your attorney, obviously. We are not lawyers and we are not giving legal advice here. So basically, here's how these fund-of-funds work and how we derive compensation. And, we deserve to be compensated for this. We found the deal. We underwrote this operator. We were able to, this is an operator who typically takes checks that are 500,000 plus versus we were bundling checks of an average size of, call it $101,000. I actually ran the math in case you can't tell. So we're making this opportunity available to our investors. We're doing the due diligence. We're putting in the work to set up the entity. We have to operate the entity for taxes and sending distributions. So we deserve to be compensated for all this work, but how? So the way it works is that our fund in the middle has its own, what's called fund economics. And what that is for our best ever listeners, you're probably familiar with things like we had a carry waterfall, our own. Now, usually this is a thinner waterfall than if you were a full-blown GP because you're not creating quite as much value as taking down the deal on your own. We also had a management fee. We also had, in our case, acquisition fee, though a lot of the times people call this a due diligence fee. And in exchange for this, typically what you have is better economics from the underlying sponsor or from the lead sponsor or person you're doing the deal with. And so, it's a pretty easy argument to make to say, hey, if I bring you $1 million, I know that you're used to raising these 50K checks, but if I bring you $1 million, can you give me better economics on your waterfall? And there's quite a lot of people who are running great deals who will say yes, and so that split between, what the standard terms are and what your better terms are for bringing much more money is where you have an opportunity to create your SPV, put in your fee structure, and still ultimately deliver better economics to your investors a lot of the time than if they were to invest directly, and you are getting compensated in a compliant manner.
Like I said, win, win, win. And that is exactly what we're shooting for here. Now, I want to go into and share a best ever capital raising tip for here, because this is very important. And that tip is go do a property walk. What was the easiest thing for us to help connect investors to the deal and therefore connecting investors' capital was obviously we talked about it to some high level, hey, here's the numbers, here's the business plan. But you know what? Let's go walk the property. Next Thursday at 2:00, we're going to go walk the property and you can see the property, meet the operator, and come out and get into more details. And, we did that property walk, Rich, and we had like 20 some people there.
Yeah, we were oversold.
Yeah. So we had a bunch of people there. And then guess what? Almost every single person that was investing or every single person that walked the property ended up investing in the deal.
Yeah. Now, best ever listeners, in later episodes, we're going to be going into a lot more detail about our capital raising process. But what I can say for now is that these in-person events where people directly meet the sponsor and ideally see the property themselves are our highest converting part of our entire funnel or our capital raising process. And so that is our best ever capital raising tip of the week is do a property walk.
All right. So let's wrap up this podcast here because we hit on a couple different points on here, and we're trying to keep our podcast a lot more action focused, a lot more nuance focused versus just all these big, sexy headlines, but actually what does it take to go out there and get the deal done? So again, point number one to recap is that we use the cheat code of finding the who, not the how. We went out there and found an amazing partner that already invested money with, and already had a great track record, rather than us spending 3, 5, 10 years scaling up in internal operations and PM companies who can go out there and do it. Second, we went out there and utilized the fund of funds type strategy so we could stay cleaner with our relationship with the operator and also stay more compliant from a SEC standpoint. And then all this ultimately helps to mitigate the risk for our investors as well. Now, from our long-term goals, from investing in deals and starting our business, is this allowed us to start scaling so much quicker, so much faster. My ability to go out there and source great operators and deals is a lot easier for me to go out there and scale up a 12-person team to go out there and run property management and construction.
And that said, we still learned a ton doing this. It's not like it's a simple thing to operate these vehicles. However, it is the simplest way to run and operate these vehicles. And that's a really important tuition that we had to learn, or really important learnings, is we learned how to set up our own fund. We learned how to do our own legal docs. We learned how to run our taxes. We learned how to onboard people. We learned how to sell and market. And the other thing we did is we started growing our investor list, which is the main part of raising capital, unlimited capital, is constantly growing your list, constantly bringing new investors, because once you've been in this game for a while, half or more of the capital you ever raise is from your previous investors. And that means like you have to start doing deals today. And it's a lot easier to start doing deals today as a fund of funds than to try and put your arms around, I'm going to take down a 40-unit building. I've never done this before. I've never raised capital. It's going to be a lot of risk versus saying, hey, I've got a great opportunity. I want to bring you in with me, and hey, come and invest with me.
And I want to highlight something here because, we've seen instances like this, and you hear about it. Richard listed off a half dozen bullet points there on additional activities we're doing besides raising capital. And that is a very clear distinction that helps you stay compliant. Talk about we're doing property walks, we're doing marketing, we're doing tax, we're doing K1s, we're doing investor relations. All that stuff is a lot of work in addition to just, hey, I raised $1 million, I'm out here, pay me my money. And that's a very important compliance standpoint. Now, as we wrap up here, I got a couple action items for listeners out here. Now, if you're an investor or an aspiring fund of fund managers, the break point for a lot of times where the economics make sense is between $500,000 and $1 million per deal. Mm-hmm. We're seeing it come lower and lower as operational efficiency increases, and we'll talk about that in future episodes. But ask yourself out there, can I go out there and combine 5, 6, 10 investors and bundle a $500,000 check? Yes, you can. And we have lots of resources. We talk about lots of resources if you don't know how to do that. But that's the break point. So if you can bundle investor checks on that, you can then go to an operator and say, I've got this type of capital. What type of deal can we do? And you'll start seeing the economics. Now, the other side, I think we have a lot of operators and sponsors listening to this podcast, because when sponsors start hearing what we do, they're like, oh my gosh, Chris, Richard, can your team help raise capital? Can you help build out marketing for me and my business? Because this sounds amazing.
Yeah, we get asked all the time.
Yeah, which is great. That's what we want, right? It puts us in the intersection between our investors and some amazing deals, and we can go out there and pick the best deals for our investors as well. So if you're an operator listening to that, start saying, okay, if I got a $500,000 or $1 million check, your economics, Richard and I don't, how can I go out there and give up some margin because you're not dealing with all that yourself, the marketing systems, the investor relations. And a lot of times it's about 2 or 3 points of IRR is a lot of times that common middle ground that makes up that spread for the fund manager.
Usually, to be more specific, it's about 20% on the waterfall. So going from either a 60-40 split, so 40 to the operator down to an 80-20, or going from a 70-30 down to an 80-10, that's the exact break point where you can set up a traditional fund of funds. Just FYI.
All right, Richard, this is a great episode. I'm looking forward to a lot more of these. But best ever listeners, if you have questions or comments, let us know. We love talking about this stuff. We love teaching about it. And we are still in the early stages of helping new capital raisers establish a fund-to-fund business out there. So join us for the journey, plug in the community, and we'll see you next Monday for the next episode.